market you trade should have something that looks a little bit like this. It's a list of drivers, it's a list of markets, and obviously it's all up to you to come up with the best options about what to put in them. You know, when you're adding in something like the ES, for example, and you say, well, what's my main drivers? Well, my main drivers are the ones that have got the closest best correlation. So you do, for example, you might start your correlations with the 1.0s, you know, and as you go further out, you might say, well, you know, so long as I'm within 0.8 correlation here, 0.6s, and then you've maybe got the 0.5s are all grouped in one group here. So obviously the wider the relationship, the more flexibility you have in its interpretation. It's not as strong a signal when it appears. Now, one of the things that's missing from this, of course, is that we don't have really any internals. You know, whereas in the Forex markets, we do have internals because we've got delta, for example, we can add into this as a picture. The delta order flow, we can have informed trading information. We don't have an awful lot more, but we also have book information. We have book liquidity, market depth, plenty of scientifically carried out studies. You know, proper PhD level studies, proper analysis that have been carried out on various systems and processes using liquidity order books and what have you. So when we move into the likes of the S&P, the same type of thing would take place. You'd work from 1.0s. You'd say, well, the Dow Jones, the NASDAQ, the Russell, these are all very, very strong 1.0 correlation type markets, or pretty close to 1.0s. As we move slightly out, we've obviously got deltas. As we move slightly out, we've got books. As we add other elements, we've got the at highs, lows. We've got tick. We've got prem. And there's a lot of stuff that are very close to the 1.0 correlation, depending upon your time frame of reference. Obviously, things like tick and prem are bracketed markets, so you're not getting a trending element to that. But as you go further out, you can obviously start thinking to yourself, right, yes, obviously, dollar yen would be a very, very strong relationship. And as you go further out, you might say, well, you know, we're going to look at the Aussie Japanese yen. Might be something that I want to pay attention to, of course, those types of elements. So we can start to see these stories, and as we go further out still, you might start adding in some of the other external markets. So you could see the XLY, XLP narrative, the XLK, XLU narrative, the basically the whole Warren line, the Merrill's line. These are all ideas that we can start stacking up on top of the quality spreads. You know, they're all possible elements. The bond curve, of course, bonds. The point is, every single market you trade, you should have a box that looks a little bit like this, where you've got your go-to internal type indicators, or what they feel like internal type indicators. And as you move further out, you become less attached to the indicator, but still are very, very interested to see exactly what it's doing. So when we look at the pound dollar, for example, and I start looking at the pound dollar and asking the question, what am I doing with the pound dollar? And you can see from the pound dollar perspective, you can see that we had this double top edge up here the same way as we had this double bottom edge down here. With the dollar selling, I buy some pounds, and with the dollar buying, I sell some pounds. There was a sellable opportunity here, there was a sellable opportunity here, but you know, that's only one aspect. That's the dollar, isn't it? That's against the dollar. And I was able to take advantage of those opportunities to make short sterling positions, or an exit of sterling and then a short sterling position, whatever it is you're doing. Now, inside of those scenarios, this is simply looking at the sterling market as a function of the US dollar market. And then as we move into this storyline of sterling, we've now looked at the euro dollar, basically the euro dollar or the DX markets. And then we say, right, what about whether there's any informed trading around those areas? And that's when we start getting into the meat of the story. We start looking for that informed trading in those areas. And that's exactly the two locations where we've been able to find informed buying in the first instance and informed selling in the second instance, allowing you to work short from those higher prints. Two simple pieces of information allowing you to make very, very effective trading decisions to take advantage of the best opportunities of the day. It's pretty simple, straightforward stuff, guys. You just got to know that that's what it is you're wanting to try and do. You just got to know that that is what the storyline is. It's up to you to construct your own information, because ultimately the driving box that you're using, or the box that you're using for your drivers, is going to change depending upon exactly what it is you see as the main drivers of the day. When you ask the question, what is the headlines? Have I got any macro fundamentals that are driving the markets, or is it a technically driven market? Is it a levels driven market today? Is it a market that feels rotational initially, at least? What is the risk tones? And we start leaning against those pieces of information. We start adding to the picture around those areas. The idea of informed trading, of course, is an old concept, but we'll be touching on that as we get into the US classroom this afternoon.